The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany, and again, our guest, Bert Dohman, author of the Wellington Letter.
Bert, thanks for joining us again. We looked at a number of different issues last week. I think one other question we want to cover today, as you look at a varied financial landscape, and certainly there's many challenges out there, you look at risk, you look at reward, and you weigh the two and start to decide where and how to invest in this environment. I think it makes sense to focus on asset preservation. What are your concerns, and where do you think people should be looking at? Would you agree that we should be looking and focusing more on liquidity and security at this point?
Yes, and Will Rogers said that many years ago. He said, I'm not so concerned about the return on my money, but the return of my money. And I think that is going to be the person who keeps the most over the next 5 years is going to be the winner. So, don't focus so much on having the big hit. Just focus on having a good return. And, that really brings me to a point. Wall Street now seems to be totally against the bond investments, and because of the higher inflation that we're seeing. I have a different viewpoint. I believe that we're close to a period where you really want to own the U.S. Treasury bond, and maybe 10 years instead of going out to 30 years. Safety is going to be it, just as you said. Safety is going to be what everybody wants. And look at what we had during the Bear Stearns crisis in March. You had Treasury bill yields going down to 0.4%, so less than 0.5%. Why? Because everybody wanted them to have safety. And I wrote at the time, I said, we will eventually see a time when the yield on T-bills, short-term T-bills, 30-day T-bills, will be negative, when people will actually pay something to get a T-bill so that they have a safe place to put their money. And that will come when we have the next big bank failure.
Very interesting to our business this week. We've hit some key technical points on gold. We've had a tremendous amount of weakness. And we have certain clients that dollar cost average in at these key technical points. I had a client out in California who wanted to place a trade for $500,000 as we got to and just below the 65-week moving average for gold. And he went to transfer assets from a Morgan Stanley money market fund and was told that he could check back in 30 days and see where he was at in the liquidation line. Not only does he not have liquidity, but apparently the assets that that money market fund has been investing in doesn't have a market on the other side. They can't liquidate the assets. They don't have a two-way market in the paper that they hold with which to create liquidity for a redemption. So here we have something that is a cash equivalent money market fund. And we're not talking about a rinky-dink firm. This is Morgan Stanley. And this is not a huge amount of money. I mean, $500,000, in the grand scheme of things, there's probably a few billion in this money market account, this money market fund.
In July last year, we started advising to all of our clients, as well as the subscribers to the Wellington, get your money out of all money market funds that are not government funds. Put it into government-only money market funds. You can buy those at any brokerage firm, and that's what I did personally. So these invest only in government paper. You don't want anything else, because I started looking around at the contents of money market funds, what they had in there, and it was just unbelievable. They had CDOs in there and credit default swaps and auction rate securities. They had instruments in there that most people had never even heard of. And now, of course, it's sitting. The auction rate securities, the Attorney General, had a settlement here last week with some of the biggest Wall Street firms, et cetera, because suddenly there was absolutely no market. They could not be sold by anyone. Now, institutional money market funds that actually broke the dollar. One I remember was $12 billion with a B. People that wanted to redeem, they were told, sorry, we'll give you payment in kind, which, if you read these extensive documents, they can do. If they don't have the money, they can't sell the securities. They can give you the securities that they cannot sell. Well, if they can't sell them, it's obvious that you, as a holder, cannot sell them either. But this was the alternative. something like this gets very little publicity.
I think that may have been the Legg Mason fund you were just mentioning. They've had a number of problems with their money market assets.
Right. Yeah.
It appears to me that the case you're making for U.S. Treasury bonds is one where there is a panic from what has been perceived to be low risk. Now the market is repricing a new level of risk. And, whether that's moving from agencies to treasuries or moving from corporate paper to treasuries or moving from stocks to treasuries, the question I would have, because that makes sense to me. I understand lowering your risk in a market that's not giving you any reward. But when you're in an environment where you have negative real rates of return, if you go back to the Summers-Barsky thesis where Larry Summers talks about the math behind why gold works in a low to negative real rate of return environment, why do you think it is, Bert, that people would go to treasuries instead of gold?
They want some kind of return, even if it's low, even if it's 3 or 4%. They would like to have some kind of return. Now, with gold, the reason you invest in gold is to get potential appreciation. And the problem is, in all of the commodities, including gold, right now at this very stage, there's going to be pressure on the price because people don't have cash. And people will look around and say, what can we sell to get cash? And they'll sell anything to get cash. The hedge funds will sell anything to get cash. No one has liquidity. That's probably the next phase. I don't know how long it will last, maybe 6 months, 5, 6 months, and so on. Then you get into the reflation period eventually. Reflation. And that means when they just step on that accelerator, they say, we have to do everything possible to get out of this mess. And then you get these massive creations of artificial money that they're going to push into the banking system. They're going to have to find a way to get all the bad loans out of the banking system, like the Resolution Trust Company. Remember that?
Sure.
And so that banks can start making loans again. When that happens, you want to just load up the truck with gold, because that will be reflation, and that will just make gold soar, just as we saw in 2001 and 2002.
We have an interesting market dynamic that wouldn't be obvious to really anyone on the street today, but with all of our primary dealers, the market makers for the physical metals, we're looking at 4 to 6 week delayed deliveries on almost every product. And we're looking at something as generic as a Krugerrand had its wholesale market premium. Generally, on the wholesale market, I can buy that for 0.5% to 1% above the spot price. It's now 4%. It's moved an extra 300 basis points higher and is still on a 4 to 6 week delayed delivery. What we're watching happening very curiously, Bert, is this. In the commodities realm, you end up having a bifurcation where the paper asset world, the paper side of the trade, whether that's futures or options, there is a run towards liquidity. But there's no liquidation in the physical markets. In fact, there's more supply going off the market than the market can really even handle. There are no secondary market coins, and this is what I mean by that. The U.S. Mint started minting American Eagles in 1986, and so anything from 1986 to 2007 is what we would call a secondary market coin versus what is coming from the mint today, a 2008 minted Eagle. I can't pay any premium because there is none available to buy any secondary market coins. I don't know if this is a temporary hoarding or what exactly is happening, but as we've watched last week, gold shed $70 to $100. It was not apparent in the physical market at all. In fact, demand has gone up, has ratcheted up significantly. There is this now changing world, even in the area of gold, where you basically have the same themes that are consistent throughout the financial system. You have deleveraging and you have a tightening of credit. When you look, you could say that the other way around. You have a tightening of credit and thus a deleveraging, which if you're looking at paper gold, whether it's futures or options, very often there's debt associated with it. And so the unwinding, the deleveraging of those plays is occurring, and of course it's hitting the price. But the